This advice is general and does not take into account your objectives, financial situations, or needs. You should consider whether the advice is suitable for you and your personal circumstances. Before you make any decision about whether to acquire a financial product, you should obtain and read the relevant product disclosure statement. Welcome. My name's Patrick Malcolm. I'm here for our GFM Wealth Advisory podcast. I'm joined by our senior financial planner, James.
Good to see you again, Patrick.
Welcome again.
Thank you.
We've done a few of these together now.
I think it's about maybe
Four or
at least half a dozen.
Good team.
Yeah, I think so. We bounce off each other pretty well, I think.
Good. And we're joined by Ofer Karliner from the Magellan Infrastructure Fund. Thank you for joining us, Ofer.
Thanks for having me.
So just before we start to talk about markets, maybe just a little bit of your career and how you found yourself into the very sexy pursuit of infrastructure investing.
Yeah, I started investing at a very young age. My dad was really into it, even though he was an engineer. So, bought the Woolworths float, bought the Combank float, the Telstra float. My mum, I wanted to be a doctor initially. My mum, the nurse, talked me out of being a doctor. He used to get doctors around the house to talk me out of being a doctor. But what else could I do? What else do I love? Investing was the answer. I started off working in consulting. I was initially in Melbourne and then over in the UK. I had my own consulting business. I was working with a lot of large pension funds. My biggest client, I was working on their private equity side, asked me to look at some infrastructure investment. And my little investment nerd inside me got really excited looking at these really high moat businesses, really reliable cash flows, structurally advantaged companies. And so when I came back to Australia, I actually made the choice that I actually want to work in this sector. So I sought out work, I did some work with the government, looking at toll roads, ended up going to sort of Macquarie and back into private equity for a while before joining the buy side about 15 years ago.
Interesting.
I think most of our clients know what infrastructure is, okay? But and they understand, what kind of assets they are. But what makes a business an infrastructure business, and why do you find it so attractive?
Yeah, I'll start with, broadly speaking, people consider infrastructure to be something that's essential for the efficient functioning of a community. I think water, power, transportation, etc. From a pure point of view, that's probably correct. From an investment point of view, we don't think that's sufficient. So at Magellan, we think what makes a great infrastructure company is actually having that really reliable cash flow stream. We want to be able to be very confident in the long-term, predictable nature of those cash flows through time, through various market cycles, to give investors the kind of returns they should expect, that differentiated, defensive kind of returns.
Okay.
So the definition of infrastructure as being defensive, is that too simplistic?
It is. It goes back to my earlier comment around the defensive nature of cash flows. Again, most people go, if it's essential service, then it's infrastructure. What we want is those stable cash flows. And what we're trying to achieve is inflation protection and diversification and defensiveness. So we strip out companies which have too much exposure to commodity prices, competition or sovereign risk. And the reason for that is you can have an infrastructure company, quote unquote, a merchant power generator. You're producing electricity, that power is needed. The problem is the price you pay varies tremendously. The cap on prices in Victoria is around $23,000 a megawatt hour. The floor is minus $1,000 a megawatt hour. Average is about
Giving it away.
70. You actually have to give it away.
Yep.
Worse than that, you're paying people to take away from you. You don't know reliably what you're going to earn over time. So likewise with commodity prices, so there's certain companies that look a lot like infrastructure, big bits of capital equipment, but their earnings are tied to commodity prices. So again, you don't know what the commodity price is going to do, and therefore you're not sure what your earnings are going to be. At certain points in the cycle, that can work quite well. They tend to be quite pro-cyclical. They don't tend to be defensive when you actually need them to be defensive. So with that very tight definition, then they are defensive, but once you have to strip out all those companies that are more pro-cyclical, more exposed to competition or sovereign risk.
So picking up on that, separating a great infrastructure company from an average infrastructure company, is it only around the predictability of the cash flows or is it more than that?
Yeah, I think there's a number of layers to it. Getting the definition right is critical, absolutely critical. Again, stripping out those companies which have undue influence. So you think about sovereign risk, for example. If the government can interfere with your property rights, and governments try everywhere to do that, but to the extent you can protect your property rights in court, that means you are protected. New South Wales is a very good example with Transurban recently. They wanted to do toll reform. They thought equalise the tolling system. They had to work within the construct of the existing contracts. So we have a lot of confidence in Australia as a jurisdiction. China has some great population dynamics, but the government has an unfortunate habit of interfering with property rights. You can't be confident in returns you're going to achieve as an investor. You've spoken about the reliability of cash flows from commodity prices. Again, you get volatility in those from competition. There's additional layers as well. So you want to be able to think about the management team quality too. These businesses tend to earn a lot of cash, and what the management team chooses to do with that cash is really critical returns you can achieve as an investor. So, in addition to pure valuation, which we use to pick stocks, we have a bunch of quality screens, and agency risk is the biggest one amongst those.
Just to pick up on this before you jump to the next question, James, the difference between an actively managed fund like yours and the index when it comes to infrastructure seems really, really important with this definition.
Yeah. There's a number of different infrastructure indices. We think basically all of them are imperfect. We have, by an accident of history, the S&P infrastructure index. Over a third of that is uninvestable for us.
Yep.
Based
on your definition
of definition of infrastructure.
So commodity price
linked, exposed to merchant generation in sovereign risk territory that we don't find comfortable. We exclude a large part of the index. So again, I think 36% at last count. So it's not really a like for like. What we look to do is try and achieve CPI plus 5 through the investment cycle. That's our internal metric. I think well-functioning infrastructure to achieve that through a cycle, and that's what we've done and a bit more over time.
Okay. If we drill a little bit more into the infrastructure asset class, you've written previously about difference between listed and unlisted infrastructure. What's basically the difference, and how do you view each of those different types of infrastructure classes?
I mean, ultimately the assets are going to be the same, whether it's in a listed construct or an unlisted construct. Doesn't matter. From a pure investment point of view. You have two utilities that are exactly the same ones, listed and unlisted.
Yeah.
The biggest misunderstanding is going, unlisted is less volatile. And it's simply because you're not measuring it.
Okay.
So if you measure it every 6 months or every 12 months, you're going to get, by definition, less volatility.
Yeah.
The underlying cash flows would be the same.
Okay.
So people go, we're having less experienced volatility. Well, it's simply not measuring it. Listed markets have a greater or broader depth of opportunity as well. We have a large number of listed companies we can look at. That volatility actually creates opportunities for us as well.
Okay.
I think for unlisted, one of the issues you have is you're kind of beholden to what's available at the time you're investing. You tend to find you end up with concentrated funds. Going back 10 years, it was renewables, a lot of wind farms, a lot of solar farms in these unlisted funds. Now it's data centers of the rage. That's what's available at the time. We have a broad range of opportunities and some of the best assets in the world.
So picking up on that offer, in terms of investing, you don't look at the next 6 months. You look at long-term structural trends. So can you talk to us about some of the themes you're viewing as being attractive at the moment?
Yeah. And the most obvious one is the growing demand for electricity across the globe. And people think it's just AI and data center demand. That is a very key component of it, but it's not the only component of it. We're seeing huge trends to electrification. Broadly, to EVs alone are very significant in the increasing demand, increasing electrification of households. There's a huge wave of growth that needs to happen to achieve net zero aims as well. So you need to build up new renewables, you need to connect them grid. Rooftop solar requires grid hardening, requires different mechanisms to deal with that change in flows. There's a massive CapEx opportunity across the globe. Data centers is on top of all that opportunity. So that's probably the biggest theme that we're seeing at the moment. On the other side of it, we see increasing government debt as both an opportunity and a risk. So it can manifest in different ways. In France, for example, they're increasing taxes. That's bad. But ultimately, the flip side of that same thing is there's been a wave of public pressure against toll roads being privatised in France. It has been for probably 15 years now. The issue is the government can't afford not to. They're so indebted. Their current budget deficit is over 5% of GDP. 5% of GDP. So they need to find ways of finding additional revenue. They can cut costs, but no one wants to do that, particularly not in an election year. So highly likely come 2032 when the next concessions start to roll off, they'll have to renew those to earn money. But that creates opportunities for investors like myself.
So further to that, clearly artificial intelligence probably the biggest investment story we're seeing at the moment. Okay, it probably followed on from the tech boom back in the early 2000s. Now it's all about artificial intelligence. You've argued the real winners are going to be the companies that supply the electricity rather than the technology itself. So talk us a little bit about that.
It comes down to the investment fundamentals. There will be winners in the AI space who will make an absolute fortune.
Yep.
Right now, you're in an arms race between multiple providers. There's huge data center build-outs. There's different AI models competing with each other. Most of them are not profitable.
Yeah.
Where that actually lands, I don't know.
Yeah, I think any of us really do at this stage.
What we do know, though, is that huge demand and power that's coming down the pipeline means that utilities need to invest to supply that power.
Yep.
And so almost no matter what happens, once you, as a utility, invested that dollar, you're entitled to return that dollar. So we're seeing huge uplifts in CapEx programs. We're already seeing it from electrification, and we're seeing a second leg of it coming through from data centers. And the great benefit of that is, not only do you spend the money and get a guaranteed return on it, you're growing your earnings profile off the back of it. But one of the big concerns we've had of late is around social license risk of increasing costs of electricity for consumers. In the US in particular, we're seeing things called large load tariffs. If you're a data center and you want to connect, you've got to pay for all of that. You've got to pay connections, you've got to pay for the digital generation. That means the cost to consumers is actually not rising as fast, or in some cases decreasing, as you build out more and more data centers. So it helps alleviate some of the social license pressures that we're seeing. So effectively, you're getting potentially low double-digit returns for very, very low-risk investment. And we're not taking that risk of the bubble popping or being on the wrong company that loses this kind of AI arms race.
Okay.
The investment that's required in this around AI, EV, and electrification generally is, and this is, I guess, one of the really big things in markets at the moment, is the market underestimating or overestimating that? Now, time will tell.
Time will tell. It's a tough question. Like the amount of investment needed for electrification is huge. I think that's probably not just AI, but electrification is huge. And I think the market has definitely underestimated that. And let me give you a case study of Australia. So the Australian Energy Market Operator is forecasting that by 2032, or 2034, my apologies, be 20 to 25% of cars will be EVs on the road. That's a 3 to 4% increase in total load demand. It's a 25% increase in peak demand. You've got to build the grid for the peak.
Yeah.
Right? By 2050, they're forecasting.
So this is people getting home from work and charging their cars.
Correct.
Yeah, they're not charging them 9 to 5. They're generally charging them when they get home.
And they've already included in that, we're going to push up the price at peak times to try and make people charge later in the day or earlier in the day. So they're already trying to adjust for that. 3 years ago, they're saying that's going to double peak demand. Now they're saying a 25% increase because they're trying to load manage it. By 2050, they're saying it's 80% increase in peak demand just from EVs. From EVs alone. Add to that, increasing household electrification, increasing industrial electrification, and then you add data centers on top of that, and all of a sudden we're in a situation where there's huge amounts of load growth coming through the system. You need to build the grid for it. So certainly, I think people are certainly underestimating. We've been talking about this for years now about how much growth there is and how sustainable that growth is as well. And to your earlier question about the utilities can be the winners here. No matter what happens, you've spent $1, you get the return on that dollar. And even if the AI or the data center growth slows, or if it disappears tomorrow, you've still got so much growth coming through the pipeline for decades to try and deal with this, with these other issues you're trying to solve.
Obviously, we talk about the growth of the electricity grid and what's needed for that. But if we sat here in 10 years' time, given all we know at the moment, what infrastructure theme do you think will be the winner? Do you think it'll continue to be around artificial intelligence and the building out of electricity, or do you think it'll be something else maybe?
I think there's a few different themes playing out. I think everyone is kind of across this is growth in demand. So they're probably underestimating the growth in demand in electricity supplies, but everyone kind of understands it needs to happen.
Yep.
One of the things we see is people are probably underestimating the impact of growing data demand for things like mobile phone towers.
Okay.
So just think about how you use your phone today versus how you used it 10, 15 years ago.
Well, 5G, obviously, and how that's growing. Yeah.
I mean, I had a BlackBerry. I'm old enough to admit how I was excited for my BlackBerry. Had a little wheel. I scrolled down and it was amazing. I was so excited to read my email on the go. Well, now you walk at a bus stop and people glued to their phones watching a video on TikTok or Netflix.
Yeah.
It seems huge amounts of data. We're talking this morning because someone has a camera in their fridge. It's Wi-Fi connected, but they can monitor what's in their fridge from home.
Yep.
And so they go to the shops, there's still eggs and milk.
Sounds exciting.
And they can turn on their dishwasher or their washing machine, all that kind. But all this needs
wasn't like that in my day.
additional data, right?
Yep.
And to densify the network.
Okay.
We've seen concerns. The tower companies all actually performed quite poorly over the last 12 months. They're down 20 to 30%. It's unusual for an infrastructure company. And part of that is rising bond yields, because these are the most sensitive part of the space we're in. Part of it is concern around direct-to-device from satellites, so Starlink.
Yeah.
And people concerned that will displace the need for towers. Now, first of all, Musk has said that's not the case. They're trying to solve it other ways, but most obviously the physics of that simply doesn't work. I think we're in a building with multiple floors above us. That signal needs to penetrate down through multiple layers of concrete. Most data usage is inside, not outside.
Yeah.
We think it'll be complementary. So it'll help. There'll be some regional areas that'll be supported by that. You may lose some regional towers at the margin, but ultimately it's not a threat. The market seems to price it like it is, and they've got underlying cash flow, underlying cash yield of about 6.5%. They're growing at the worst case we can come up with is 3.5%, 10% underlying yield with probably upside.
Yeah.
It's very attractive. It's a very low risk business.
Yeah.
So getting to stocks now, can you give us the quintessential Magellan infrastructure stock at the moment offer that fits the characteristics that you're talking about?
Yeah. So I just spoke about towers. Cellnex is probably what we see the biggest value opportunity at the moment. Again, there's the second layer of mispricing that I can talk about in a second, but it is Europe's largest telco tower operator, and it's about 20,000 sites across Europe in 10 different markets. It has been beaten up. Let's step back in history. It spun out of a company called Abertis, and it went on a massive debt-fueled M&A spree across Europe trying to roll up the sector. It was very, very heavily geared. Market loved it. It was trading insane valuations in our view. Every broker had it on a buy, and we were like,
we don't want it.
It's way overgeared. We wouldn't touch it. Roll forward to last year, the stock sold off significantly. Off the debt costs increased massively. Had a new CEO come into play. He rationalised the business. He sold non-core assets. He paid down debt. They paid paying the first dividend this year. The stock buyback last year. So they've actually corrected a lot of the historic issues. We see cash flow growth, underlying cash flow growth by growing about 3 times, about 100 million by 2028. There's the opportunity to double again over the next couple of years after that as their large CapEx program rolls off. What the market's focused on right now is consolidation in Europe of telco operators. So in a lot of markets, there's 4 players. And most of those 4 players are sub-economic. What we're seeing is underinvestment in the networks. But now they're starting to consolidate. And people are going, well, actually, you've gone from a market of 4 potential customers to 3. That's bad for you. But we've been digging down a little bit. And we go, well, we've met the company 21 times now over the past 18 months. 11 meetings with customers, former employees, suppliers. We've spent a lot of time understanding this company. The contracts that they have, first of all, are what's called all or nothing contract. This is critical infrastructure for the telco providers to use. You can't, at the end of that contract life, go, I only want these great sites here. You have to renew all of them or none of them. If you renew none of them, you don't have a network ultimately. So they're in a really strong contractual position. We're looking at France at the moment. There's a potential breakup of one of the telco players to the other 3. They have effectively a veto right over that because to split up the network, you actually have to split up the contract. So saying, we have a seat at the table here. But what we have seen where that's happened is actually because of the historic underinvestment in telcos in Europe, network quality is really poor. Go to Italy, I've got 5 bars, but I can't make a phone call or send a text. So in the UK where we saw a merger, the Vodafone 3 merger, one of the stipulations was will allow the merger to happen, but you have to go out and spend £11 billion over the next 8 years to upgrade your network. We think that's a template for what's going to happen in other markets. So there's a huge opportunity there to actually grow the business, not just to preserve the capital, but to grow it over time. So, we're quite confident in the long-term story here. I think the market's really missing here.
And that second layer of value that was that in...
The second layer, so I talked about the people concerned about the satellites, and the second layer of mispricing is really around the misunderstanding of this risk of consolidation.
So if we delve further into some of the stock-specific stories, is there a particular holding that maybe illustrates how you think a little bit differently to the market and the broader index, where you've probably seen an opportunity that the market's clearly not seen?
Italgas is a really good example. Italgas, it's Italy's largest gas distribution company.
Yep.
So it spun out of a company called Snam in 2016. Share price popped a little bit after that, but then kind of went sideways for years. So this company cut OPEX by about 40% between 2017 and 2024. It gets to keep about half of that for 5 years, the Italian regulatory model.
Yeah.
Market didn't care. It was yielding roughly 8% per annum, and that was growing.
Yeah.
We consider them to be the best management team in the sector anywhere in the world. They spend a lot of time with those cost programs doing things like digitizing processes. Let me give you an example. They used to send an engineer out to site to fix a pipe or check a pipe. You then have to send an inspector out to check the work the engineer had done. So what they did, they built an app. Every engineer carried an iPad with them. They did the work, they took photos within certain specifications, and the inspector would sit in the head office and go, actually, yep, I can tick off, save myself the trip out there. So no trip out there, time saving, network downtime saving. If there is a problem, the engineer's still on site. He hasn't left.
Okay.
So, very simple things, but they accumulated to be very, very valuable over time.
Yeah.
In 2024, they bought the second largest gas utility in Italy. They forecast cost savings of €250 million per annum versus $269 million of OPEX for that company when they bought it. So almost the entire cost base is being ripped out. They're doing that without sacking anyone. There's no headcount loss.
Okay.
Simply through efficiency measures. So again, the best management team by far in the sector. The market was very focused on energy transition risk, going, Europe's going to see gas go to zero.
Yeah.
The reality of that is they are very forward, but it was always net zero. Like even the government's own forecast in Italy said, worst case, you're looking at about a third reduction in gas usage by 2050.
Yeah.
Worst case. So we were very confident in the underlying demand dynamics for the business. We were happy to hold it earning 8% per annum, and that was growing at very attractive rates. Last year, the stock was up 98%.
Wow.
The market basically finally caught up as they got less concerned about.
Understood the story.
Yeah, understood the story. So we took a long-term perspective on it.
Yep.
We held it for a couple of years before the market corrected itself. There's numerous examples of this.
Yeah.
Or we will hold things for long periods of time. Eventually the market catches up, understands, appreciates the value because we are long-term investors.
Yeah, of course. Interesting.
The most important things when you're analysing these businesses, is it pricing power? Is it regulation, management quality, capital allocation, barriers to entry? I'm assuming it's all of them, but how do you sort of weight it when you're...
I mean, there's some gating elements to it. So again, for us, the barriers to entry, most of the companies that we call economic moats have very strong economic moats, very hard to replicate a utility. It doesn't make economic sense to replicate a utility.
We're going to avoid using the word monopoly here, aren't we?
Well, they're regulated monopolies, that's fine. And the reason the regulation exists, same with toll roads, the regulation exists at consumers.
Of course.
Because they are such strong businesses, such strong franchises, same with airports. If you let the companies price at will, those prices would be higher. So they have very strong economic moats. So, that gives a lot of confidence in their earning capability through time. So management teams are so critical to our investment, to our assessment of companies. Again, what management teams choose to do with the capital and how they allocate the capital can have a really big impact on your returns as an investor. We spend a lot of time trying to understand the management team's motivations. We look at REM reports. We look at their history of the quality factors. It's the largest quality factor we consider. But again, there's Warren Buffett said, buy a company that any idiot could run because eventually someday somebody will run it.
Yep.
But these infrastructure companies ultimately, almost in all cases, are such good quality businesses that they can withstand a poor management team running it.
Okay. As we know, there's risks in everything, and we're doing all sorts of investments, and that, and you've got to obviously manage those risks. But what are the biggest risks you think in infrastructure assets? How do you manage those? Does it cause you to change your view about particular stocks?
I mean, social license risk is probably the biggest one
okay.
that we face as infrastructure
and we're
investors.
seeing it now, obviously, with data centres out, some suburbs around Melbourne and Sydney and things like that.
It's happening everywhere. So even where we're seeing data centres notionally approved in the US, all of a sudden the communities come up in arms and they have to get pulled.
Yeah.
The social license pressures, we saw New South Wales do a toll review, and ultimately getting the strength of the contracts there meant that Transurban was actually fine off the back of that. But if you abuse or damage that social license, it can have very adverse consequences. The most obvious example at the moment is in the UK, UK water space in particular, where a number of companies, particularly the privately run ones, let's say the listed companies, abuse their social license. They underinvested in networks. They dumped sewage. The Thames Water is the famous example. They dumped 2 billion litres of raw sewage into the Thames. They have all sorts of service quality issues. And the whole sector's come under a huge amount of pressure. Now, for the good actors, it's actually beneficial. Svan, Trent, United Utilities have highest environmental ratings in the sector. They're very top-class operators in the sector as well. They've managed to benefit from that in terms of part of the problem has been underinvestment in the networks because the regulator has deemed we want to keep costs down rather than allowing them to actually invest properly. There's been an acknowledgement now that that model is broken. So they're allowing them to invest multiples of what they were historically. So the current regulatory periods are a big step up on the prior ones. So they'll benefit from that, from increasing investment. That's probably going to take 20 years of investment to rectify those problems.
Final question, Ofer. Markets are very, very noisy. They've probably never been noisier. How do you and the team avoid getting distracted by the short-term headlines?
In short-term, that's why we always talk about value. We don't talk about, we almost never talk about quarterly earnings or get caught up in those kinds of details. Can make it, you look at what the outcome of that impact is to value over time. It's very easy for people to get very myopic. The example I give to the team and to people who want to speak to them is I used to cover the oil and gas pipeline sector, midstream sector in the US. I remember sitting there in a meeting. It was a shared meeting with another investor, and every single question he asked was around effectively trying to work out what the next quarter's earnings were going to be, or next quarter's cash flow was going to be, or next quarter's dividend was going to be. Or I was asking about the business. I was asking about what long-term value is, strategic questions. And it just shows how, focused people are on that very narrow field. That gives us an informational advantage. If you can look through that noise over the long term, that means there's mispricing opportunities that come from that. So we tell the guys to look at value. We don't spend a lot of time dealing with broker reports. We kind of try to get to understand what the market sentiment is. Obviously, we're in a live market. We need to understand what people are thinking. We don't rely on brokers for our work. We do it all ourselves.
Beautiful. Thank you, Ofer. I really appreciate you joining James and I today to talk about Magellan's world of infrastructure investing.
No worries. Thanks for having me.
Thanks, Ofer. It's great. Thanks, Patrick.